Hello everyone, I'm Asian Guy. There's a structural shift underway in the global economy that most people still misunderstand, and because it moves slowly, it rarely makes headlines. It's not a recession, it's not a market crash. It's the quiet exhaustion of monetary policy in a world that no longer functions without ever-growing debt. The consequences of this are long-term, institutional, and deeply political, but they're being discussed as if they're temporary technical problems. That mismatch is where the real risk sits. Before we go further, subscribe right now because what you're about to hear explains a shift most people still haven't noticed. For decades, monetary policy has been treated as the ultimate stabilizer. When growth slowed, central banks cut rates. When markets broke, they added liquidity. When debt piled up, they made servicing that debt cheaper. This approach worked for a long time, not because it solved structural problems, because it postponed their consequences. And postponement slowly became policy. Let me walk you through how we got here. After the inflationary crises of the 1970s, central banks rebuilt credibility by committing to price stability. High interest rates imposed discipline. Debt was painful, so borrowing stayed constrained. But once inflation was broken and credibility established, rates could fall, and every cycle after that reinforced the same lesson for governments, corporations, and markets. Debt would be accommodated. Look closely at what happened over time. Each downturn required lower rates than the one before. Each recovery relied more heavily on asset prices than productivity. Each crisis expanded the role of central banks further into the financial system. This wasn't a conspiracy or a mistake. It was rational behavior within the incentives of the system. Governments learned that fiscal discipline could be deferred. Corporations learned that leverage boosted returns. Financial markets learned that risk would be cushioned. And voters learned that painful adjustments could be avoided, at least for now. Now notice what changed. Debt is no longer a cyclical feature. It's structural. Public debt, private debt, and financial leverage have all grown faster than the underlying economies meant to support them. Growth hasn't disappeared, but it's increasingly dependent on credit expansion rather than productivity gains. That's a crucial distinction. Monetary policy works best when debt is low and future growth can absorb today's borrowing. But when debt becomes the condition for stability itself, policy shifts from steering the economy to keeping it upright. This is where the limits begin to appear. Interest rates can't rise meaningfully without destabilizing governments, housing markets, and financial institutions simultaneously. But they also can't stay artificially low forever without distorting capital allocation and eroding currency credibility. Central banks are trapped between financial stability and monetary integrity, and both are weakening under the strain. This pattern has appeared before, not in identical form, but in recognizable structure. Late-stage empires, heavily financialized economies, and debt-dependent systems all face the same problem. The tools that once stabilized growth begin to undermine it. Look at incentives again. When borrowing is cheap and expected to remain cheap, investment shifts. Capital flows toward assets that benefit from leverage rather than projects that raise productivity. Financial engineering outpaces real innovation. Risk migrates from visible places to hidden ones, and the system becomes more fragile, not less. But this is where it becomes important. Central banks don't operate in a vacuum. Their power depends on trust. Trust that inflation will be contained. Trust that currency retains value. Trust that institutions are acting within limits. Once policy becomes the only thing holding the system together, that trust starts to erode quietly. You can see it in behavior, not rhetoric. Longer-term inflation expectations become less anchored. Asset markets react more violently to small policy changes. Governments assume continued accommodation as a baseline, and central banks themselves communicate more carefully, more defensively, more ambiguously. None of this means collapse tomorrow. That's not how slow institutional failure works. It works through normalization. Emergency measures become permanent, exceptions become rules, and constraints become narratives rather than boundaries. The real story here isn't about interest rates, it's about legitimacy. When monetary policy is asked to solve problems it was never designed to fix, it inevitably fails at the ones it was meant to handle. Price stability, currency confidence, and long-term planning all suffer. We're living in a system where debt has replaced growth as the organizing principle. Monetary policy didn't create this alone, but it enabled it, and now it's constrained by it. In the next part, I want to slow this down even further. I want to examine what this tells us about institutional credibility, public psychology, and the durability of the current economic framework. Not as a forecast, not as a warning shot, but as a structural reading of where we are and why the tools we rely on feel less effective every year. Because once you see the limits clearly, you start to understand why the system behaves the way it does, even when it seems irrational on the surface. What we're really observing now is not policy failure in the traditional sense. It's institutional saturation. The tools still function, but their side effects have grown larger than their benefits. And that changes how people interpret authority, competence, and control. When monetary policy was effective, it operated quietly. Rate changes guided behavior at the margins. Liquidity smoothed cycles without becoming the cycle itself. Most people didn't think about central banks at all. That invisibility was a sign of success. Now they're everywhere, in headlines, in market narratives, in political debates, in everyday language. And that visibility matters because it signals dependence. Look closely at how markets respond today. Small shifts in tone from central banks generate outsized reactions, not because the information is new, but because expectations are fragile. When stability rests on continuous accommodation, even minor uncertainty feels systemic. This is the psychology of a debt-dependent system. Debt changes time horizons. It pulls future income into the present and assumes future conditions will cooperate. When that assumption becomes widespread, institutions stop planning for resilience and start planning for continuity. The goal shifts from building capacity to avoiding disruption. That mindset doesn't stay confined to finance. It spreads to politics, regulation, and public expectations. Painful trade-offs become unacceptable. Structural reform becomes politically impossible. And policy gradually transforms from decision-making into risk management. This is where institutional credibility begins to thin. Central banks are still respected, but less believed. Their statements are parsed for reassurance rather than guidance. Their independence exists formally, but their constraints are obvious. They're expected to preserve growth, support markets, finance governments indirectly, and control inflation simultaneously. Those goals increasingly conflict. Notice how language changes in these environments. Words like temporary, transitory, and exceptional become permanent fixtures. Policy frameworks expand in scope, but shrink in clarity. Accountability becomes diffuse because no one wants ownership of outcomes that can't be controlled. This isn't unique to the present moment. History shows this pattern repeatedly. Late-stage institutional systems often appear most sophisticated just before they lose coherence. The complexity increases, but effectiveness declines. Rules multiply, but enforcement weakens. Authority persists, but legitimacy erodes. And legitimacy is the quiet foundation of any monetary system. Money works because people believe it will retain value. Policy works because people believe it operates within constraints. Once those beliefs soften, behavior changes subtly but decisively. People hedge more. Institutions shorten horizons. Capital becomes defensive. Trust shifts from systems to strategies. This doesn't produce immediate crisis. It produces gradual fragmentation. Financial markets become less reflective of real economic conditions and more responsive to policy signaling. Asset prices drift further from underlying productivity. Inequality widens, not only of income, but of insulation from risk. Those closest to monetary flows benefit first. Those dependent on wages and prices absorb the adjustments later. Over time, this reshapes social expectations. Stability is no longer associated with institutions, but with interventions. Confidence becomes conditional, and policy loses its ability to surprise in positive ways. This is the structural limit we're approaching. Monetary policy can still delay outcomes, it can still redistribute stress, it can still manage narratives, but it can no longer restore the conditions that made it powerful in the first place. Low debt, high productivity growth, demographic expansion, political consensus. Those were the foundations. They're weaker now. So what does this mean? Not for markets next quarter, but for the next decade. It means we should expect more friction, not more collapse. More volatility around policy decisions. More tension between inflation control and financial stability. More reliance on administrative solutions instead of market signals. And more pressure on institutions to do things they were never built to do. It also means that credibility, once lost, won't be rebuilt quickly. Trust accumulates slowly and dissipates unevenly. And when people sense that the system's promises exceed its capacity, they adapt quietly, not loudly. That adaptation is already visible. None of this requires panic. But it does require clarity. We're not watching a temporary distortion. We're watching a mature system testing its own limits. And those limits are not technical, they're structural. Understanding that changes how you interpret policy, markets, and institutional behavior. It reframes confusion as constraint. It explains why solutions feel smaller even as interventions grow larger. This is not the end of monetary policy, but it is the end of the era where monetary policy could compensate indefinitely for structural imbalance. That distinction matters, because systems don't usually fail when everyone expects them to. They strain when assumptions quietly expire. And right now, the assumption that debt can expand faster than capacity without consequence is being tested in slow motion. Thanks for watching. Subscribe, share this, and stay alert. Because what's happening beneath the surface right now matters more than most people realize.